So what exactly are mutual funds, index funds? What are the differences and how do you actually make money off of them, or when can you withdraw? Well, we're going to talk about all of that in this video. And just to clarify, even though I do actually write technical articles for financial advisors, I am not licensed to be able to say, hey, you should go invest in this and have it legally be substantiated. So don't take anything that I say as actual absolute fact, truth, or any means for going and investing without doing your own research. So let's start with mutual funds, and don't be scared off by this definition, but mutual funds are essentially professionally managed portfolios that that investors can pull their money together and basically start or activate these funds. So instead of having individual single stocks that you invest in, like Disney, Amazon, Netflix, Apple, whatever, you can actually buy mutual funds that have a combination of all these companies in one, and usually they're in different sectors. I think it's really important to have a good understanding of some basic investing things, even if you're not actually managing your own investments or portfolio right now, or you haven't even started investing. This is a great way to kind of educate yourself a little bit and feel more comfortable about where you're actually putting your money. So there's four different kind of broad definition of mutual funds that you can invest in. So the first one is equity funds, and these are mainly single stocks. So they're going to be a little bit more volatile, but they also have the potential of giving you a higher return. Then you have the fixed income mutual funds that are primarily bonds, and bonds are a lot lower risk, but they also give the lower returns. So usually you'll see people who are in their later years of life or have a really, really low risk tolerance for investing in the marketplace choosing these fixed income mutual funds. And the other two are money market funds and a hybrid or a balanced mutual fund. So that the balanced or hybrid one is basically like a combination of stocks and bonds, which is good because it balances out more of the volatile aspects of stocks, but with the bonds that are more conservative. So those can be pretty popular for people, especially if you choose to put part of your investments in that and then maybe a larger percentage in the equity stocks to have a higher chance of getting higher returns in those. This is a pretty high level video, so I'm not going to go into any more detail than that. And if that was already confusing, go check out like even Investopedia. Even if you just signed up for their emails, they do daily definitions that can kind of give you some self-education really simply without feeling overwhelmed. So index funds are actually a type of mutual fund. I think a lot of people think that they're completely separate, but an index fund is just another form of a mutual fund, and the difference there is that it tries to match or track with another standard mutual fund. So it basically takes the average instead of trying to beat the fund. An example of an index fund would be the S&P 500 index fund, which is the Standard & Poor 500. And basically, this is a fund that combines the 500 largest publicly traded companies. And since the S&P 500 index fund is a weighted fund, that just means that the larger companies dictate more of the value of your investments. So if Apple were to go way up, it would make more of a difference on your investment than a lesser value tech company, or whatever it may be. Apple is a big company within the larger 500 companies, so they have more sway on if the value of your investments go up or down. So some of the big key differences between the mutual funds and index funds are that mutual funds are actually actively managed funds. So, and index funds are passive, so there's not a whole lot of management going along with those, which also means that there's less fees associated with the index funds. So that's another big key difference, is the fees that you're going to pay in order to actually invest in mutual funds versus index funds. For example, mutual funds have an average of about 1.4% of an actual management fee, because Basically, the way mutual funds work is that they're trying to beat the market. So if you have an investor or a financial advisor who's working on this, or even if you're just putting money into a Roth account or your 401k and you have chosen a mutual fund, then that mutual fund is going to try to beat the market, whereas an index fund actually just matches. So you're going to get the average of whatever the market chooses to do with those funds. So basically, it's either a guaranteed, you're going to get the average with this, or you can pay more in management fees and try to get a higher return, which, depending on where you choose to invest in and who you choose to have as your advisor, if you're not doing it yourself, then it actually, I do have a little bit of a bias here, so I'm going to give you the full disclaimer on that one. But if you have less than $100,000 in investments or net worth, whatever, I would say do your own research and obviously maybe do a consultation with a financial advisor, get an idea of if they would be a good fit for you in terms of how much you actually want to have in retirement. If your portfolio is going to look a little bit more complicated, great, go ahead and hire someone. But I would say index funds are a great way to start investing yourself and know that you're going to get the average return on those investments. So as you can see, I'm sure there's a lot of debate on mutual funds versus index funds, and there's different statistics and studies that show that over the long haul, because of the management fees, that can really cut into the return on your investment, your ROI. Index funds can be really great, even for people who are not paying for an advisor to actively manage their portfolio for them, because usually actively managed funds are about 1.4% or higher, but index funds can be anywhere from 0.05 to like 0.2% for some of the higher cost index funds. So that's significant, because if you're looking at an average index fund of about 7% as a return on your investments, and most mutual funds there isn't really a guarantee, obviously, but they run more around like 8 to 9%, then depending obviously on what you choose and how you're investing. But you basically knocked out that margin right there just with the fees associated with that fund by choosing to try to beat the market instead of match it and just keep lower fees. So for that reason alone, because of the fees being a little bit higher, usually index funds can be a great choice, especially for people who don't want to have to pay for an advisor who is going to charge anywhere from 1 to 3% for their management fees, plus higher costs associated with mutual funds. So basically, index funds are great for kind of like just set it, forget it, reinvest your dividends. I'll get into that in just a second. But mutual funds can be better for short-term investments, which I don't personally think are great ideas in the first place, but they can give you the option of beating the market in a certain season so that you can gain more money with your investments. But most people don't choose to look at their investments that way. So this leads us to how you can actually make money off of these investments. And is it just when you retire, or can you get some money now? So basically, if you're going for retirement, obviously I would say you don't want to be taking anything out. But a couple ways that you could be getting money right now from your investments is you can actually earn dividends off of the interest earned on your bonds and stocks within your portfolio. So basically, you can choose to either accept the dividend and get it as a regular paycheck, or you can choose to reinvest so that that dividend is just going towards increasing your investment for retirement, which I highly recommend doing. Just don't take any kind of dividend, have that be reinvested in your investment, and that's what's going to give you that larger retirement when you actually want to take that money out. Another way you can gain money is, and this is not for, you would have some type of tax or penalty just depending on what you're actually investing in. But if you choose to let the money grow, say you buy at a lower price and the capital gains, so basically the stock value goes up, that's capital gains, and that makes your investments worth more. You could also just cash out at that time or sell or transition or buy a different kind of stock or investment, and that's how you could gain money that way. If there are any topics that I haven't touched on specifically, then please go ahead and comment below with some things that you would like to learn more about, and please comment below with any questions you have that I might be able to answer. Thanks so much.